Why do investors typically underperform the market? What can we do to avoid making decisions that really hurt our investments? And how can investment fees totally wreck our retirement? We'll answer these questions and more on this, the 22nd episode of the DoughRoller Podcast.
Welcome to the DoughRoller Podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the podcast to help you take your finances to the next level. Well, I decided this would be the no-edit podcast. You know, if I edited out every single mistake I made while trying to put together one of these podcasts, I don't think I'd ever produce one. So I just let my stay in the podcast. It kind of gives you a sense of, I suppose, of the real me, for better or worse. Today is the 15th day 15 of the 31-day money challenge, and in some ways, it's kind of the day I've been waiting for. You know, we've gone through a lot of basics, everything from setting goals to tracking your net worth to budgeting to painless ways to save money, your credit score, getting out of debt. We are finally I think it's got to be my favorite topic, and that's investing. And we're going to cover investing over a number of days. It's a critical topic. I just absolutely love the subject. I've read a ton about it. You know, I manage our investments. I have for 20 plus years. And, you know, it's a, you know, like it or not, because of the 401k, we can all blame it on the 401k. You know, back in the day, there were no 401ks and IRAs. Folks did not have to invest for themselves. They had Social Security. They had pensions, defined benefit plans. Well, today it's all about defined contribution plans, which is just another fancy way of saying 401ks and IRAs. And so, like it or not, we're all investors, or we all should be investors, even if it's just a company 401k. And so it's an important topic, and it's a topic that I think troubles a lot of people. It's not easy. I mean, there's so much you've got to, understand. Maybe asset allocation. You've got to understand how to pick mutual funds. You've got to understand investing fees. And then amidst all of this, we've got to control our own impulses. Our own impulses to sell out of fear when the market's tumbling. Our own impulses to just jump into the stock market when it's on the rise, like it is now with a 32% gain in 2013. And so you've got all these sort of psychological issues. You've just got a question of knowledge and understanding investments. It's a lot. And so it's an important topic. It's what we're going to cover at length beginning today. And I'm happy to kick off this topic with an interview of Carl Richards. As you'll learn, Carl is a CFP, and he's the author of a fantastic book called The Behavior Gap: Simple Ways to Stop Doing Dumb Things with Money. I just love that title. It's an excellent book. I'll leave a link in the show notes to that book. And you may have seen, Carl is kind of known for these little illustrations. He'll draw very simple illustrations to convey a complex topic. And you'll see that in his book. You'll also see that on his website. I'll link to both. But Carl's going to be on the show in just a few minutes to sort of kick off this investing topic. And I'm thrilled that he agreed to come on and be interviewed. Before we get to the interview with Carl, though, I do want to thank our two sponsors for this 31-day money challenge. The first is Betterment, an online platform that it helps you invest your money. You pick the percentage of stocks and bonds that you want. They then invest them in low-cost ETFs for you. They also rebalance your portfolio automatically. They reinvest your dividends for you all automatically at a very low cost. You can check out Betterment at betterment.com. And our second sponsor, Personal Capital, they have a free online tool. You can aggregate all of your investment accounts, retirement and non-retirement. You can see your performance across all of your accounts. You can track your asset allocation across all of your accounts and your fees. It's a great tool. I use it every day. You can check them out at personalcapital.com. Thanks to both of our sponsors for making this 31-day money challenge possible. So we're going to turn to the interview with Carl. But I do want to say that after the interview, I'm going to share with you a resource. It's a website. It's a free resource that I think everyone needs to read. It'll literally take you 20 seconds to look at this resource and understand it. It's very visual, but it shows you just how damaging high investment fees, high investment costs can be to your portfolio. Now, we're going to spend an entire podcast in a few days on investment costs, how to figure out what a mutual fund will cost you and how to understand the impact of fees on your returns. We talk about it briefly in the interview with Carl. We're going to cover it more extensively in a few days, but this resource is something you really need to see. I'll describe it in a little more detail after the interview with Carl, and of course, I'll leave a link to it in the show notes. But let's go ahead and go to the interview. Carl, welcome to the show.
Thanks, Rob. Thanks for having me.
So, I'm thrilled to have you on the show. As I've told other folks, I'm a big fan of your work, not only your book, Behavior Gap, but also I guess you'd call them illustrations that you do that I think in some ways, a simple illustration can speak volumes. And for those listening, if you've never seen Carl's drawings, just go to Google to the images and type in his name, and you'll see what the work that he does. But with that, Carl, can you just give folks sort of a bit of your background and how you came to get into the world of finance?
Yeah, I mean, the really short version is it was one giant accident. I mean, I actually in college was looking for a flexible job because I was a full-time student, and my wife and I found an ad in a paper that we thought was for a security job, like security guard or mall cop or something. Right. So I went and applied for it, and somehow made my way through the interview process and got offered a job at a large brokerage firm. It turns out the ad said securities, not security.
Oh, that's funny.
and I didn't know the difference. So that's how I got into the business. And then I went from working at this large firm, it was Fidelity Investments, and then I worked at a couple of big brokerage firms. And eventually I got my certified financial planning designation, and I found myself trying to explain what people view as pretty complex problems. And I kept having a repeated experience where I'd be looking across the desk at people trying to make some really important decisions about their life savings. And they kept having these blank stares on their faces, like they had no idea what I was talking about. And I did my best to describe it simply and clearly. And then one day I, out of almost desperation, grabbed a pen, and said, no, like this, and drew it on a piece of paper, whatever the concept was I was describing. And I noticed everything changed. I mean, it wasn't like a big dramatic moment, but in hindsight, I realized, wow, things got it was a lot easier to describe if I drew it, if I sort of sketched it out. Now, I'm no artist, as people will find out real quickly as they see my sketches, we call them. But, I noticed that it made a difference in how people understand it. So I started doing more of them, started putting them up on the web, and one thing led to another, and a couple, newspapers asked me to do them for them, and it really began with the New York Times. So that's how it all started. And then I've been doing one a week for the New York Times for the last 3.5 years. So I've got a background I'm a certified financial planner. I've been giving financial advice for 20 years now, and the thing with the New York Times started about 4 years ago now.
Okay. All right. Well, yeah, the drawings or illustrations, they're simple, which is actually why they're so powerful, at least to me. And they're great at communicating relationships and behaviors that either we should try to avoid in some cases, or perhaps follow in others. But okay, well, let me get right down into the weeds right away. I've read your book, Behavior Gap, and one of the things you point out is the difference between an investor's return and an investment's return. And I'm quoting from your book. It says, typically the studies find that the returns investors have earned over time are much lower than the returns of the average investor, or average investment. So my first question is, why is that the case?
Yeah, and that's really where the very first sketch came from, was trying to help people understand the difference. So just to make it really clear, imagine that you see an investment advertised that had a 10% return, a mutual fund that had I'm just picking numbers out of the air, a 10% return for the last 10 years. It averaged 10% a year for 10 years. That's the investment return. right? So this mutual fund, 10% a year for 10 years. Now, if you put your money in at the beginning and you didn't add or take any away, and you left it there for the whole 10 years, your return would be what?
10%.
Yeah, 10%. So in that case, the investment return of 10% and the investor return would be the same. But nobody invests that way, right? Like the average hold time for an equity mutual fund, by definition, a long-term investment, is under 3 years now. So we're always moving in and out and changing and making these changes based on what we hear in the news. And so very rarely does somebody actually earn the return that the investment got. So that's the first thing people really need to understand. There's a difference between an investment and an investor. And I think once we start understanding that, we start realizing, wait a second, like I could, based on all the studies, I could probably own an average mutual fund, by definition, mediocre. And if I just behaved correctly, I would outperform 99% of my neighbors. If I just didn't buy and sell it, and I just held on to it. And even over the last 10 years, it's true. People are, that's true in the past, but this decade, no, actually it's not. I mean, the average mutual fund did relatively well over the last 10 years if you just put your money in and stayed there. So that's where that concept came from. I refer to that difference between the investment return and the investor return, that gap, as the behavior gap.
And so why are folks, if we know what we should do, we know we should put our money in mutual funds according to a plan and leave it there, why don't we do that? What causes us to want to buy and sell?
Yeah, and people have often asked me, like, okay, you read about mistakes. What's the biggest mistake people make? And my answer normally is, well, we buy high and we sell low, right? And that sounds really, well, duh. Of course, your mother probably taught you when you were 7 that investing is the opposite. You buy something low, you hold on till it's higher, and then you sell it. Well, so the question is, why do we make that mistake over and over? Why, and the reason we make that mistake over and over is because we're human. Right? This is kind of hard for people to get their heads around. Like, it has very little to do with intelligence. We can know something on a theoretical level or an academic level to be true, and then emotion gets in the way and we misbehave. And so, to give you an example, when the market is going up, right now is a great example. We've had, I don't even know last year the broad market, whether you want to use the Dow Jones Industrial or the S&P 500, was up over 30%. The Dow was up about 29, and the S&P was up a little bit over 30 if you include dividends. But from the bottom in 2009, we're up. I don't even know what the number is. It's a huge number, 126% or something. And we're starting to see signs that people that swore off investing in stocks in 2009 said, I will never invest in stocks again. I just lost 50% of my money. I'm never going to do it again. They promised they would never do it. We're starting to see signs that people are like, maybe the stock market's okay. Now, why is that, right? Well, it's because it's natural to look at the recent past and expect it to continue into the future. We call it hindsight bias or the recency effect, where we look back and we say, oh, you know what? It's been sunny for 3 or 4 days. I don't think I need to take the umbrella today. And we do the same thing with this. We've done this for a long, long time, right? Sort of metaphorically, if we didn't behave this way, we would have all been eaten by saber-tooths a long time ago.
Right.
So we look back and we say the stock market's done well. Oh, you know what? It turns out it's not so risky after all. We put our money in. The news is telling us that it's good. Our neighbors are telling us that it's good. Everybody's feeling better about it. And we say, okay, fine, we'll invest in stock. Now, what happens when the market goes down is the exact opposite. You hear people say things like, this will never stop. We'll never fix the European debt crisis, like we heard that one, right? The U.S. economy will never recover. And then people start saying, if this continues, I've got to get out of the market now, because if this continues, in 18 and a half months, I'll have zero. Like they've actually projected out how long it's going to take at this rate for their portfolio to be worth nothing. Not realizing that, you know what? Things change. We're now projecting the recent past that's been bad indefinitely into the future. not realizing that, wait a second, it's not going to go on indefinitely. This is normal for things to go up and down. So instead of what we normally do as Americans, where we get really excited to buy things on sale, we return them to the store when they're on sale. We return stock. Like, I don't care how much it's marked down, just take it back. So that's why we make the mistake. It's totally normal. It has nothing to do with intelligence. It has everything to do with how we're hardwired to get away from things that cause us pain and get more of the things that give us pleasure.
Well, if we're hardwired that way, but we know it's the wrong way to behave if we want to grow our investments and we want to retire sometime before we're 100,
yep.
What do you tell your clients? What can people do? What tips do you have? Tips you can give them, whatever, so that they will avoid the temptation to sell low and to buy high.
Yeah, of course. So I think that, the first one is just recognizing that that's a human tendency. And this is what's so cool about, at least this field. We have records to prove what your behavior's been. So the first thing is to put on sort of a no shame, no blame hat. and with that hat on, and make sure your spouse has it on too. Very important.
Right.
Then go look at your past. The last 10 years are a fantastic sort of petri dish for us to look back at and say, all right, how did you behave? Did you get excited about, you can go back even further. Did you get excited and buy tech stocks in 99? Did you sell in 2002 after the market was down? Did you get excited about real estate, in 2007? Did you sell your stocks in 2009? So if you go back and look and just see how you behaved and be really honest with yourself, you've got your no shame, no blame hat on, so it's okay. Like, we're trying to learn something here. So you look back and you say, okay, I've proven to myself that I can't really behave. In fact, it turns out I'm normal. I do what most people do. I buy high and I sell low too. Okay. Once we've gotten there, then we've got to build in some automated behavior to basically put guardrails, I like to think of them as guardrails, up and prevent us from doing these things. So the first automated behavior in my mind is make sure you have a plan.
Right.
So sit down, either with yourself, get some help online, find a reputable, trustworthy financial planner or financial advisor. Sit down, figure out what your goals are. And it's a pretty simple process. Get really clear about where you are today. I say that. For most people, actually, it's not a simple process. It sounds really simple, but here are the steps. Get really clear about where you are today. In other words, build a personal balance sheet. Make a guess about where you want to go, and I use that word purposely. Don't burden yourself too much with a false sense of precision that you've got to know what your utility bills are going to be 27 years from now, right?
Right.
Make a guess of where you want to be, and then look at the gap there and say, okay, what do I have to do? How much do I need to save? What return do I need to get? Based on that, you should relatively quickly be able to come up with what we refer to as an asset allocation. The better way to describe it is how you're going to split your money between stocks, bonds, and cash. And let's just say, based on your goals and your values and where you want to go, that you need to have 60% of your money in stocks. And that's not based on what's going on in the news. It's based on your goals. Okay. Then now you've got, okay, I'm going to have 60% in stocks. Then you figure out how to populate that plan. I'm a big fan of using low-cost passive investments. You get 60% in stocks, and now your goal is to just simply stay the course. And every year revisit it. See, if you just inherited a bunch of money, you may not need to have 60% in stocks anymore. If one of your goals went up, you decide you want to retire early, maybe you need to have a little bit more in stocks. Who knows? But you keep adjusting it, sort of course corrections along the way, and you make decisions now. Your investment changes to your investment plan should be made based on changes in your life, not changes in the market. And then you implement, I think, the ultimate guardrail, which is the only change you make to your investment plan that's not based on your life, is to simply rebalance, which we can talk about if you want to, but I think that's the ultimate tool to prevent yourself from doing silly things.
Right. Well, let me ask you this then, and all of that makes perfect sense to me. In fact, in this 31-day money challenge, we've already talked about a personal balance sheet, and as a starting point, and I like the idea of making a guess of where you want to go. I can tell you, I can just go back 7 years ago when I made a commitment to be debt-free in 10 years, and I couldn't have guessed in a million years what the next 7 years would look like for me. They've just been a total, complete change. So I like the idea of a guess. On the asset allocation plan, to me, and I think you've even written about this, the question of stocks versus bonds is really the question.
Yeah.
There are other questions.
It's the only. It's almost the only question.
Yeah. You've got, domestic versus international, whatever. But at the end of the day, it's how much you're going to put in stocks. How do you help people answer that question?
That's a really good question. It's something I'm working on right now. I'm working on my next book, which will be called The One-Page Financial Plan, and I'm trying to, because it's so important. It's like the predominant question. You add everything else up together, and it doesn't equal the answer to this one question. So, but how do we make it really simple? So I think there's a couple of ways to go about it. Like, I think the ideal way, in an ideal world, you'd have a financial plan that was detailed enough. So here are the inputs, right? Like, where are you today? Clear picture of where you are today. Where do you want to go? What are your resources you can commit to it? In other words, what can you save every month? So you look, and I'm saving my 401k, plus after that I'm saving, $200 a month, plus you get all that stuff. And then somebody somewhere makes some rate of return assumptions. So, if you assume 10% versus if you assume 6%, you're going to get different answers. So somebody has to be the assumer. I like to call him the evil assumer. Somebody's got to guess what that return is going to be. And then out of that really complex process would flow, okay, if I assume I'm going to get 6.5% rate of return, and I assume X for inflation, and I'm here today, and this is the resources I have, out of all of that would flow an asset allocation. It would say, okay, based on all those assumptions, the inputs you put into this computer program, you need 57% in stocks and 43% in bonds. That's pretty hard, and there's a lot of guesswork in there. I know people who do a phenomenal job at that guesswork, and they treat it as really educated guesses, and they update it every year, and they do a phenomenal job at it. That's the ideal scenario. For most of us, we can't get there. You can't find somebody that you can trust to do that work. You don't know how to do it yourself. So there's some shortcuts. One of the classic shortcuts is you take your age and you put your age in fixed income or in bonds, and you make them really safe. It's sort of intermediate maturity, super high quality growth stuff. You take your age, so let's just say you're 35. You put 35% of your money in the safe stuff, fixed income, sort of CDs, bonds, that kind of thing. And you would take the inverse. You'd take 100 minus your age. You'd take what's left, right?
Right.
You put 35% in fixed income, then you would put 65% in stocks. And then on the stock side, the default choice should be the Vanguard S&P 500 index fund, right? Like, that should just be your default. I'm not saying if you're going to deviate from that, I think you have to have some arguments as to why. So to make it really simple, you put 35% in a broad-based, short to intermediate term stock fund. Bond mutual fund, and you put 65% in the S&P 500 index fund. That plan, and then every year you change it to reflect your new age. Mm-hmm. So next year you would move to 36% in the safe side, and 64% on the aggressive side. And so that would be your plan. I think, look, there are certainly ways, and the people I work with, I know lots of advisors that do a better job than that, but the ways to do worse than that are infinite.
Right.
So that's one default way. The other default way that people use is just simply to say, okay, I'm going to have the 60-40 portfolio, almost the institutional portfolio, which is 60% in stocks, 40% in bonds, and I'm just going to hold that for the next 20 years of my life, and I'll get whatever return the market gives me, and I'll make the adjustments with how much I save, or I'll adjust my goals. It is what it is. I can't do much better than that. Both of those. Go ahead.
No, go ahead. Well,
I would say both of those answers.
Right.
Both of those answers are far better than what most people are doing now.
Yeah, the age in bonds thing I think is interesting. I kind of like that, although I confess I don't follow it. I'm 47, and my asset allocation is about a 60-20 split. The concern I have with the age in bonds approach, and I've mentioned this on my blog before, is that when you're really young, for example, if you're 20, I just find it hard to get to 80-20 at that age, unless, of course, holding more is going to cause you to make dumb decisions. So, I mean, part of this whole equation is, will you be able to stomach your asset allocation when the market is down 40%, right? Which is, I think, a big thing. But then I also wonder at the back end, when you're 60, should you really be holding 60% in bonds? And I guess for some people, maybe the answer is yes. I mean, that's part of all of this. It's so individualized.
Yeah, there's no question there's problems, right? Like, I love Churchill's quote about democracy, that democracy is the worst form of government ever created by the mind of man, except for all the others.
Right.
And I think this rule of 100 is the worst way to invest your money ever created, except for all the others.
Right, sure.
And so, yeah, there's certainly problems. You could argue that a 60-year-old, should they really have 60% in bonds? But I would tell you that the average 60-year-old that had 40% in stocks in 2008, 2009 was not able to handle that.
Right.
And wish they were more conservative than that. Now, right now you're saying, well, 60% in bonds, I'm getting, 1.8% return on that 60%. Well, yeah, I know. But
if you're lucky.
The dilemma, if you're lucky. The dilemma is, of course, when we have another downturn, which I hope everybody believes will happen, right? I have no idea when. I just know you're going to wake up one day and your portfolio is going to be down, your stock side of your portfolio is going to be down 30%. The news is going to be bad. Everybody's going to be screaming, get out. You're sitting here thinking, I'm 65 years old, and what am I thinking? I have 35% in the stock market, and now it's down 30%. What in the world am I thinking? I got to get that out now, right? I think if we were having this conversation in 2008, you and I may be having the opposite side, like, wow, you really think a 60-year-old person could hold 40% in stocks? You know what I mean? So,
well, yeah, that's the thing. When you're sitting there making the plan, it's easy to make a plan and come up with a number and divide your investments in stocks and bonds with whatever you decide. But sticking to that, it depends on your personality. For some, it's going to be harder to stick to it when the market's going down. For others, it may be harder to stick to it when the market is going up.
That's true.
That's
true. I often think of that as like fear or greed, and that's why looking back 10 years, you can sort of get a sense of like most of us are loss averse. That's kind of almost at this point it's a settled doctrine. Most of us feel the pain of loss at least twice as powerfully as we get pleasure from gain. But there are the rare people who just can't stand missing out when the market's up. And they're like, I'm fine when the market's down. I just can't stand missing out when the market's up. Well, that means you need to tilt your portfolio to the direction of making sure you never miss out on upside, right?
Right.
But most of us are going to fear is going to be our driving behavior in this.
Yeah. Well, Carl, listen, I know your time is limited today. Let me just hit one last topic before I let you go, if I can.
Sure.
You'd written an article in the New York Times, the Bucks blog, I think middle of last year, about the dull task of decoding 401k fees.
Yeah.
And apart from the trading fees that a mutual fund incurs, which are not part of an expense ratio, I take it that all of the 401k fees, whatever they are, eventually get boiled down into the expense ratios that people see when they look at the individual funds inside their 401k. Is that correct?
I mean, occasionally that's probably that is mostly correct.
Okay.
Occasionally the participants, and you don't see this very often, but it's just important to note because it's easy to see if you are having it. Occasionally the participants pay a platform fee or a plan administration fee, but very rarely. So yeah, most of the time 401k fees are going to be embedded. Most of your fees are going to be embedded inside the mutual funds in the form of an expense ratio.
So if you find funds in your 401k, an index fund or whatever that's 5 or 10 basis points, you can generally rest assured that you're avoiding what could be extremely high fees that maybe other funds or other 401ks charge.
Yeah, in fact, it's this is getting better. This is getting better, but it's still a big problem. I almost feel like if you do nothing else in your 401k and you make this asset allocation decision we talked about, and you've got to decide where to put your stock money, especially in the 401k, there could be landmines in there. Like you could have a very low cost passive fund, or in other words, an index fund. It will probably say something like S&P 500 index fund. You could have that at 5 or 10 basis points. Inside a lot of those plans that have that option, there's also XYZ large cap growth fund that's 3.5% fees, right? Like because they're trying to make up for the fact that other fund is there.
Okay.
So I almost think you can get it. It's pretty easy. I haven't seen a 401k in a long time where you can't ask, hey, can I please get a list of all my fund options and the expense ratio? And you can almost just go down the expense ratio column and get to the one that's below 0.5% and say, oh, look, that's the funds I'll use. I mean,
right.
the only thing we've noticed that has predictive value in terms of what will do well in the future, because that's ultimately what we're trying to do, right? We're trying to find investments that will do well in the future. We don't care about what's happened in the past. The only thing that has predictive value, hair color of the manager, what school he went to,
right.
None of that stuff has any predictive value. Past performance doesn't even have any predictive value. The only thing we found is expenses. The higher the expenses, the worse you'll do.
And are there occasions where a fund inside a 401k actually has a higher expense ratio than if you were to go outside that 401k and invest in the same fund directly with, say, whatever, Fidelity or whoever is offering the fund?
Sure. Yeah, they have different share classes for inside retirement plans. It could be less too. I mean, the point is it could be different. That would be somewhere else.
So you just got to figure out what it is before you make the investing choice.
And it shouldn't be hard. I mean, your HR person, this is not like a tricky question. Nobody at your company level, nobody would be upset at you for asking it. It's a pretty easy question. Can I get a list of all my mutual fund options and their expense ratios?
Right. Critical. Okay. Yeah. Well, besides your own book, of course, what book are you reading, or what's one of your favorite personal finance or investing books?
Oh, that's a really good question. I mean, I have two colleagues that have both written fantastic books. Dan Solon has written a whole series of really good books that I like. And Larry Swedroe has written, I think we're at 15 now. He's at 15 now. Really good books that I've enjoyed. One of my favorite, it's hard to call it an investing book, but Fooled by Randomness by Nassim Taleb is one of my favorite books. And I believe it would be fair to call it about investing.
Absolutely.
It's understanding, you know what I mean? So that's one of my, Fooled by Randomness is one of my favorite books, for sure.
Yeah, it's a great book. And I actually interviewed Larry for this 31-Day Money Challenge. So, okay, great.
Yeah. And Larry and Dan have both written books that I think are fantastic. Like, if you're going to only read one book about how to actually get this done, both Larry and Dan's books are fantastic about just... What's Larry's the only investment guide you'll ever need? It's actually an appropriate title.
Okay. Well, I will be sure to link to their pages in Amazon and that book as well. So, all right, Carl. Well, listen, I really appreciate your time today. Thank you so much.
Thanks for having me.
Well, I hope you enjoyed the interview with Carl. I found it very helpful, very insightful, and I think it's a good start to the investing topic. A very good sort of high-level perspective. As I mentioned before the interview, there is a resource that I want you to know about. I'll leave a link to it in the show notes. It's part of PBS Frontline, and it's called The Retirement Gamble. It's a very long URL, so again, I'll just leave a link to it in the show notes. But it shows you how retirement fees cost you. And you kind of scroll down, and it talks about 401ks, it asks you some questions, but you don't have to input anything. And it just walks you through how over a lifetime of investing, you can pay literally 6 figures in retirement fees. And I know that seems impossible, but it's not. Investment fees matter. They are very, very significant, and they can add up over 20, 30, 40 years of investing. And this resource sort of just visually walks you through. You scroll down, and it'll show you a couple different statistics and some information. You really need to take a look at this. As I said, it will only take you literally, let's say, no more than 60 seconds to read through it and digest it. It's a great way to visually see the significant impact of fees on your investment return. So I will leave a link to this in the show notes. I highly encourage you to take a look at it. And so with that, it brings our podcast to a close. As always, you can get the show notes to this podcast by going to DoughRoller.net/podcast22. You can leave a voicemail for me. Love to get your questions and comments. Just go to speakpipe.com/DoughRoller. Email me at dr@DoughRoller.net. I read every email and respond to every email, even the nasty ones, which fortunately aren't too many. Love to get your questions and comments. Shoot me an email. You can subscribe to this podcast at DoughRoller.net/iTunes. That will take you to the iTunes page where this podcast resides. You can subscribe. You can also leave a review. Love to get the reviews, positive and negative, so that I can make this show as helpful and useful as possible. You can subscribe to our newsletter, DoughRoller.net/newsletter. Send it out every Saturday, packed full of resources and tips. So until next time, remember, the best thing money can buy is financial freedom.